So how can you use whole life insurance as an investment? Newsflash, it's not. In fact, it's illegal to say that this is an investment because it's not. It's more like a tax-free supercharged savings account, but it's not an investment. So if anybody ever tells you, and you hear this on the videos and stuff, just know they are lying to you straight out. But I will say this, it can be one of the best tools you use to help grow and protect your money while also getting your money to pay you in two places at the same time. So let's just dive right in, and be sure to watch till the end because I'm going to talk about how you can get that money to pay you twice. All right, so let me just dive into, again, explaining that this is like a tax-free savings account. It is not an investment. It's not being invested in anything. The great news is for it not being an investment is that it's also safe, right? This is something that where we know that the money will grow. It's guaranteed to grow each and every year. Every company has a different one. Usually you'll see between like 3 and 4% as a guarantee, and that's awesome. That's what we want to see because that's the minimum you can get. Oh, key point here. Insurance companies, one of the things you want to look for is how long have they paid dividends above their minimum, and for how many years have they done that? For example, some of the companies I've used, like 2 of them, for example, have paid straight every single year above their minimum for 170 years. That means they've been paying all the way through civil wars, not revolutionary, World War I, II, Great Depressions, recessions, you name it, they've always been paying out consistently, and they pay more than their minimum payment. That's essential, right? That's just so huge. One of the companies I'd like to use a lot has been going on now over 175 years that it's always paid out. So you want to make sure you have that good track record. I like 100 years plus is my ideal. That means they've paid through depressions and everything. But you want to make sure that this is not an investment. This is really a place to save. Now, how do you use it? How do you use it with investing though? Because I still can use this money to invest, but I'm not investing inside of it. One big misconception is that people think this might be like an IRA where you can invest inside of an IRA, right? You don't do that here. This is really like a savings account that you would withdraw, or in this case, we often teach to borrow the money from the insurance company versus pulling the money out of it, and then using that money to leverage to earn money here, while also investing it somewhere else. So let me show you, because a lot of times people say, well, what does that look like? Well, let me show you an example right here of one of our clients that was doing just $10,000 a year, right? And in fact, I was even doing this as an apples to apples comparison with another company. Kicked the crap out of it, by the way. But you'll see that on the screen right here. He's been putting the $10,000 a year. Just in year 1 alone, you'll see it's kind of highlighted in yellow there. He's got over $7,700. Now, just so you know, with whole life insurance, they're front loaded in their costs. It's more expensive in the first few years. And then about year 3 or 4, those fees back off dramatically. And so it gets to the point where eventually it pays for itself. You'll even see in this case, it starts making more than what he's putting in by about the 3rd to 4th year, right? But already he puts in $10,000, he's got about $7,700. This is key because understand that most time that you see the traditional whole life plans, especially the ones that people rip on, which they should rip on them, they'll have a 0 for year 1 and then 0 for year 2. You'll see in year 2, this guy's got over $16,000 putting in that same money, not 0. So you can already see what we're saving him from the traditional plan. So yeah, you'll see here we only do it for 15 years. He's got over 200 grand. Now this by itself, you'll say, well, that looks like a horrible investment because really it took him about 5 or 6 years before he broke even. Is that really worth it? Well, that's the case if that's all you do with the money. If all you do is just throw your money in here and just let it sit there, no, it's not going to do much. It's not going to be sexy, right? It is kind of cool. It's kind of sexy that if you notice there, after the 15th year, he pays nothing for the rest of his life. That's kind of cool. He's got a death benefit forever, and he's got cash value that's guaranteed to keep growing tax-free. That's awesome. But again, this is not where you get rich. If anybody ever tells you in infinite banking that you're going to get rich from infinite banking alone, that this is the magic bullet, do not believe them. They're liars and just being salespeople, snake oil salesmen, basically, right? That's what they're trying to do. I've run these numbers all kinds of ways, with my numbers being better than theirs, and I still can't justify saying, yes, this person got financially free only from doing this one method. This has to be used with other methods, whether it's investing in your business, and ideally a business that can generate some other streams of income, and or investing in things like real estate. You can do things, you can invest anywhere you want, but I like real estate better because I can generate cash flow from those investments. That's where I like to see it happen. So let's use an example using this guy's same numbers here, right? Say that, for example, like right there, year 6, he's got $61,000 in there. Say that he borrows $50,000 from that. He used that as a down payment on a property. Now let's just say that property pays him $400 a month or about $5,000 a year. He would take that $5,000 a year and use that to pay back towards his line of credit. He would start to pay that loan down. Yes, they're charging him interest, but he would be paying more than the interest being charged. Right now, by the way, interest rates are right around for loans, right around 6%, which is roughly about the same that they're paying us in the dividends right now. So he's using that money to pay it back. He's starting to pay down that loan plus the interest as it pays down. Less and less gets charged interest, more and more increases in cash as time goes on. So he starts to pay down that loan. Now he doesn't have to pay it off completely, but what he can do with this is he can actually get that money to keep working, because again, he's compounding that money. And you'll notice that again, there's still a net gain happening despite the fact that he had used that money from the insurance company to then go and do that. So that's one thing that's kind of nice. It's kind of cool to see that this really works in a real applicable way. And that's where you see that income, that interest that you're earning, the dividends you're earning will exceed the loan interest you're paying, making money here and in your investment at the same time. Okay, now this next thing, because a lot of times people say, well, why would I use this? Why wouldn't I just have a savings account, right? And you can use a savings account. There's nothing wrong with having a savings account. Again, but for me, from my investor perspective, I like leverage. I like to get every little lever I can pull to get more out of it. I like to do so. Well, here's an example of a savings account. Now this example, it shows you here, it's kind of hard to read because it's taken from a spreadsheet that I made. This is someone who had $250,000 that they could invest. They had $250,000 to save, that they could do that, but they were also saving roughly about $30,000 a year that they were putting away. And this was based on a real client situation. He was max funding his 401k, he was even saving a little bit into savings, but then he had $250,000 in his bank account that he could be investing. Now, most infinite bankers will say, hey, just take all that money and dump it all in. I don't agree with that at all. And so I said, well, let's just take an example. Let's say that he's saving $30,000 a year. He has $250,000, but he can invest that making 10%. So he's making $25,000, which means really he has $55,000 in the first year. So that's why in year one, this is someone who's just not even using their policy, just using a savings account, right? If they just use a savings account, earning that money, you'll see $55,000 in year one is what he saves, making himself $5,500 that year, 10% on that money. Now his cash flow goes from $25,000 a year that he was making off that $250,000 to $30,500. You see how that kind of compounds his income even, as eventually after the 10th year, he's about $112,000. If he wanted to get to $10,000 a month, it would take him another year and he would be there. So it would take him about 11 years to get to the point where he says, now I'm making $10,000 a month. Now, that's the yellow one. Now notice this green one over here. This one I wanted to be fair, right? Because remember, there's those upfront insurance costs. So there's gonna be less to invest in the first year. But same thing, still be investing that $250,000, right? Making that $25,000 a year of cash flow. But then he's got the $30,000 a year he's putting into the whole life versus into a savings account. And then he's using the cash flow from those investments to then pay down that loan is what he's doing. So you'll see that here, so that we're taking the whole life plus savings. And you see it looks a little complex, but notice like the first year, like for example, he's getting a loan of $18,000 in that first year from that policy. He's using some of that money, but that first year's cash flow, it's only got $4,700 a year coming in versus the $5,500 on the other side, the yellow one, right? But notice that as time goes on, because there's higher interest being paid on the whole life than what he's making in the savings account, and of course it's tax-free too, that helps as well. You get that momentum going, especially when you get past that 5th year, then he really starts to catch up. And really by even the 5th year, he's not too far away. You notice it's only like a few $100s a year away on the cash flow. But eventually, by that year 10, he gets up to the point where he's over $120,000. He actually hits in year 10 that $10,000 plus cash flow a month. And by the way, I was using actual real policy here. So this was their example. Again, results can vary depending on your age and health rating. It could be better or worse. But this, in this guy's example, is what it looked like. And that's even based on interest rates not going up in this policy, which the cool thing is, guess what? These rates have actually started to go up. Dividends actually started to increase year to year recently because of the higher interest rates. So in a lot of ways, the numbers could even be better than what I've been showing him here, just depending on how that plays out. But that's the key thing, is because you've got that compounding interest working in your favor, because it is tax-free, because you're not losing money to taxes and everything else. Because of that reason, you're actually able to do better than a savings account. And that's where this works with investing. Remember, this is not the investment. This is just a tool to throw a little extra gasoline on your fire of investing, right? That's what this is really used for. And remember, the big thing is this, is that it's not just because you're earning a higher interest rate, it's that double arbitrage, right? You're making money in two places at once. You're making money net extra gains over here inside the policy, and you're making money over here. If you drain out your savings account, you're not making interest. You lost the ability to earn money in two places at once. That's the key difference, and that's how this really works. That's why banks have been using it, businesses have been using it. That's why a lot of wealthy investors have been using it for many years, and they're not going to take the time to teach you. But as you've just noticed here, we are taking the time to teach you here as well. Now, as a free offer, of course, I know it's a lot of numbers. I try not to get very technical because sometimes you get lost in the weeds. But if you want to see numbers of how it works in your situation, you can actually go to moneyripples.com. There's a place you can go to actually click to book a meeting with an insurance specialist where you can figure out how to create this max ROI infinite banking, right? And we'll tell you flat out, if this is not for you, don't do it, right? Like, we don't want you to do something that's not a right fit. But if it is right for you, you can actually see how those numbers will really play out for yourself to see how it worked for you in your situation and what you can actually do with it. So be sure to go on moneyripples.com, book that call today.